Hi, David Campanile here, owner of Campanile Law, located in the great state of New Jersey. We handle estate planning and probate. As always, if you'd like to set up a strategy session with me, you can contact me at njestateattorney.com. So, going back into the lovely world of taxes, as it is tax season here, wanted to talk to you guys about capital gains taxes, actually. So this is something outside of the estate tax that we would normally pay. So the question I get a lot is, well, I'm inheriting my parents' house. How does this get calculated into the estate? Well, the estate taxes are paid on the accumulation on the amount of the full estate, which that is calculated into. But this number is very, very high. I think it's almost $12 million at this point on the federal level, and the state of New Jersey doesn't even have an estate tax anymore. But we still have the capital gains tax to pay. So how does the capital gains tax work is if your parents purchased a home for, let's say, $100,000, and when they passed away, the home was valued, and they sold the home at $150,000, they would be taxed on capital gains on that $50,000. But the assessment value is the date of purchase of the home, or the amount that they've purchased at. But that changes in estate planning with the inheritance of this property or asset. So you're receiving a home. Let's say your parents bought it for $100,000, but at the time of death, your parents' death, it was $200,000. Well, now you have a $200,000 home. If you go to, and that's your asset now, when you turn around and go to sell it, if you sell it for $300,000, you have to pay a capital gains tax on that $100,000. So the capital gains taxes are changing, and I'm not 100% sure under the new administration what the rate's going to be set at. But you would pay a capital gains on that $100,000. But remember, a lot of people are like, well, don't I want the lower value from when my parents purchased the home? No, because if your base assessment was $200,000 and you only made $100,000, you're only paying a percentage of that. And let's say for example, the capital gains tax is 10%. You're only paying $10,000 to the government. If you took it at your parents' base value at $100,000 and sold the house for $300,000 at a 10% capital gains tax, you're paying $20,000 in taxes. So you kind of want that higher base amount because you're going to pay less in taxes. However, of course, if the property value dips, you're not paying a tax on the loss. You're only paying a tax on the gain. So this is something that a lot of people, you have to sit down once or twice to explain to, that yes, you have to pay this gains tax on the assets when you hold on to them and they accumulate value. Or even if you've received them right away, and let's say you received the house today at $200,000 and you turn around and sell it for $200,000. Well, you didn't gain anything, you didn't lose anything on the value, so you're not paying anything. That's really how the capital gains tax works with estate planning. I use the house because it's more tangible than if I'm talking about stocks and bonds. So, as always, my name's David Campanile, owner of Campanile Law, located in the great state of New Jersey. We do estate planning and probate. If you found this video informative, please hit the like button, hit a thumbs up if you're on YouTube. Please like our Facebook page, subscribe to our YouTube channel. If you know somebody who this video may benefit, please share it with them. Tell them you were thinking about them. Stop by, say hi. And if you want to schedule your 45-minute strategy session with me on estate planning and probate, you can contact me at njestateattorney.com.